Good day and welcome back to Market Ka Gyaan. I am Narendra Solanki. So, where did we left last? We left at the discussion where we were discussing ROIC and WACC relationship. And while discussing that, we arrived at a new formula, and that formula was excluding goodwill and cash. However, that formula we introduced, then we also told that that formula is used in specific cases, and one of that specific cases were reinvestment decisions. So when a company makes reinvestment decisions, that formula is used, that new adjusted formula is used. But why so? We'll find out in this video. So what is reinvestment rate or reinvestment ratio? Reinvestment ratio is nothing but whenever a company or a business wants to assess how much reinvestment needs to be made in order to grow at a certain growth rate in a 1 year time frame. So for example, let's take an example of company A. A company A wants to achieve a growth rate of 10% in its net operating profit after taxes. So the company wants to estimate how much reinvestment rate should it have for its predefined ROIC. So in this case, the reinvestment ratio formula is expected growth rate divided by ROIC. So for 10% growth rate, if a company is having 20% ROIC, that means 10% divided by 20%, which comes out to 50%. So a company needs to invest 50% of its net operating profit in order to achieve 10% growth rate. So this is the plain simple way how a reinvestment ratio is calculated. But if you closely monitor this ratio, the higher the ROIC is, better for the company. Why is it so? Because here ROIC is in the denominator, and when ROIC is higher, then your investment rate and reinvestment ratio would come lower. So the company needs to invest lower amounts of sum in order to achieve similar growth. So now you got to know why we reduced goodwill and cash from that earlier formula, and because of that the ROICs were higher, so that company can take a perfect decision of its true ROIC and true reinvestment which is need to be made in order to grow the business. So this is how the internals of the formula work for the company. So friends, that was all about the ROIC. Now let me conclude it for you with these two lines. The ratio is one of the most important financial metrics for quality investors, as it indicates how efficiently the management is allocating capital. As a quality investor, you are seeking for compounding machines. These stocks have a high and consistent ROICs with a plenty of investment opportunities. This will allow the company to grow its free cash flow exponentially, and in return, the share prices would also reflect the same in the long term. Thank you. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.